Okay, right. So really, this is just carrying on. Really, I'll just come here. This is just us carrying on with the chapter. I just broke. I pretended as though the class was having two segments, so to speak. So what do we have here? So we carry on, but this time we're selling off the asset, for example. And really, the only thing to be careful of really here is we're just selling off as you would expect. We selling price less the net book value at the time. And that goes into the, just like as we would have any disposals, that would go into the statement of profit or loss. But all the business going on in the revaluation reserve that we have accumulated over time will go straight into returned earnings. So two steps to disposing of a revalued asset. It should be accounted for in the statement of profit or loss of the period in which the disposal occurs. Any balance on the revaluation surplus relating to this asset should now be transferred to the retained earnings. Note, of course, this does not affect other comprehensive income. So nothing's affecting other comprehensive income in this year. The profit or loss, anything on the disposal goes straight into the profit or loss, but we have revaluation reserve where all other comprehensive income over the number of years has been going into, and that's what goes straight to retained earnings. You're really moving from revaluation reserve, one reserve, to, if you like, retained earnings, another reserve in your statement of changes in equity, if you like, if you think about it that way. Let's look at this question. Derek bought this property for 750. We'll do the double entry in a second. On the 1st of Jan, useful life of 10 years. It has no residual value. Let me just create a page. I will use this page here. So the man bought this thing for 750,000. That's the asset. And it says that the intention is to hold it for 10 years. So therefore depreciation will be 75,000 every year, right? Because 750 divided by 10 is 75,000. And at the 1st of Jan, 31st of December, the property was revalued. So that means that by the end of the first year, accumulated depreciation is 75,000. So what do they do? Then they revalue the property to 810,000. They actually give us what's going on here, recognizing the additional income, or the, not additional income, the gain to statement of other comprehensive income. So what you have here, of course, is that if you take that to 810, I'll just change my pen color. What I have to do is to 810, that must be 60. And then technically, I'll just say that's OCI. That's 60,000. And that's 75,000 coming out of there, of course. And that's 75,000. That's why they give us the 135. We know that already. Okay, so this is now 810. Right, so what happens next? There's no change to the useful life. Okay, great. So that means we have 9 years left. And 2 years, I believe, 31st of December, 2004. And then so we go basically 1st of Jan 05 to 31st 05, December 05 to 31st December 06. So we have 2 more years. So let's do that. So now we have something that's 810 with 9 years left. So depreciation over those 2 years, or if you like, accumulate. So, I mean, that's 810,000 over 9, isn't it? So you have 90,000 each year. That's the depreciation. Isn't it? 9 is 81 is 9, so 90,000. So 2 years of depreciation means that accumulated depreciation will basically be 90 times 2, which is 180,000. So basically 90 each year. Yeah, transfer to income statement, 90 transfer to income statement, right? So that's what you have. You have 180,000 here. So it now says that you sell this thing for and what you didn't do, it tells you didn't do what we did earlier on where you did the transfer to balance it out. You don't have to. It says Derek does not make transfers of realized profits in respect of excess depreciation. Okay, so anyway, you sell it for 900,000. Yes, so just coming back to the double entry, let's just do the disposal. If you remember your normal disposal account, is I'm going to get rid of this 810 out of here into my disposal, 810 here, get rid of the 180 here, 180 here. You've sold it for 900,000, bank 900,000, this 900,000 over here, and therefore you have a gain. In order to balance all of this out, if you remember, here you have 180 plus 900. 180 plus 900 is equal to 1080. So if I'm balancing this out, I have 1080,000 minus 810. So I have here 270. So my gain in my statement of profit or loss is 270, right? So credit this, of course, and you have your gain on sale of 270,000. Okay, right. And then finally, the last thing we have to do, of course, is we have this retained earnings sitting here, sorry, this revaluation reserve of 135. So what we now need to do is transfer that 135 from here into retained earnings as well. Well, I mean, that's in revaluation reserve, right? Because this is the income, and this would have gone to the revaluation reserve, and then I would now transfer that 135 out of this into the retained earnings. So, and there you have it. And that's how we deal with that. Okay. Let me fire off a little. I think I can speak a little more to get to the 10-minute point. It's talking about government grants. So governments often provide money or incentives to companies to export or to promote local employment. You can have two types of grants. You can have your revenue grants, contribution towards payroll costs, for example, or you could have capital grants. So these are grants, if you like, for example, the purchase of non-current assets. And there are two options, really. Two general principles. Grants should not be recognized until the conditions for the receipt have been complied with, and if you like, there's reasonable assurance the grant will be received. Grants should be matched with expenditure towards which they intend to contribute, and that's really the aim, the point here. So this will the recognition of the grant will depend on the circumstances, and really it's watching to see how you're paid the grant, but it's about the matching concept ultimately. So really, if the grant is paid on a different basis, certain non-financial objectives, such as the creation of a specified number of jobs, the grant should be matched with the identifiable cost of achieving those objectives. So let's look at revenue grants. You have two options: present as a credit in the income statement or deduct from the related expense. So it says look at illustration 4, and it's an illustration. I'm just going to go to the textbook. So you see this if you go to the textbook. Here we are. Textbook of to illustration 7. Let's look at that quickly. Oops, sorry. Must be here. Yes, here we are. So it's just to show you what's going on. Entity gets 300 grand to keep staff employed in an area. Entity must not make redundancies for the next 3 years, or grant will need to be repaid. So by the first year, no redundancies have taken place and none are planned. So you've got debit bank. What you currently have right now is debit bank credit this deferred income. So what it really wants is, like I say, should be recognized over the period, is you're supposed to release that grant over the 3-year period. So what you now do is debit 100,000 to the deferred, right? Debit deferred. I mean, it's really just saying, here we are, really. So you got debit, you had bank deferred income, 300,000. And what I do every year, as long as I keep these people in employment, is to release 100 out of here into revenue income. 100,000 every year until I get rid of that deferred income. And that's really the point there with that illustration. This can be shown as a separate line, or deducted from admin expense. It's up to you. As 100,000 will be released to the statement of profit or loss, the remaining of 200,000 will remain in deferred income over the 2 years, and that you just pretty much yes, of course, classification of this 100,000. That will be classified within current liabilities, and the other between non-current. So if you remember, the standard requires us to always show things that happen within a year and then things that happen after 1 year. So you need to classify that as well. Right, let me just see if these when the next question is coming. Yes, so I will be at TYU 5 in a second. I think I can definitely so in terms of capital grants, there's two options, and they're kind of straight as well. Write off the grant against the non-current asset. So you bought the thing for whatever, we'll see a question, for 10,000, you get a grant of 5, literally deduct the 5 off the 10 and just depreciate as normal. Or, interestingly, kind of keep them separate and just release, so depreciate your asset of 10 and then also release the grant to match the depreciation as you're going down, right? So treat the grant as a deferred credit and transfer a portion to revenue, so offsetting the high depreciation charged on the original cost of the asset. So looking at TYU5, TYU5, here we are. So entity opens a new factory. In fact, you know what? Let me just snippet this out so I can write on it very quickly. Just take this out and put it on my slide. Boom, 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 boom. Almost there. Capture, capture. Yes. And yes, here we are. Let's just right. And let's see if I can insert this quickly. Okay, great stuff. Yeah, that's good. So what are we saying here? We have here new factory receives a government grant of 15,000. So this is what happened. Double entry, bank 15, deferred income 15. In respect of capital equipment costing 100 grand. So you are going to go out there and buy your equipment for 100 grand, and that's bank. So you have two options. You have two options to literally just credit deferred income of 15,000 against this 15,000. That net book becomes 85 and depreciate 85 over 5 years, right? This is 20% straight line. So you could just do that, and that becomes what, 17,000 each year, and that's it, done. Or you could depreciate the 100 grand as you are of 20,000 if you like, and release 3 every year from here, your deferred income, because right, 3 times 5 is 15, so deferred 3. So the net is still 17, irrelevant whatever method you use, but you decide how you wish to do this. Okay, great stuff. So in some cases, grants may need to be repaid if the conditions of the grants are breached. So if you breach those, you will have to pay it back. You will have to kind of put through an expense to credit any liabilities that you owe, and then pay the grant back if it's probable. And we do see situations like that. So if you've used it, you have to kind of pay it. You may need to reverse any amounts to profit or loss depending on the repayment required. Yeah, so I think really, like I say, you might have to put through a liability if it means that you need to get through to the full cost of the grant to set it back up, so you can actually pay the grant, pay off the grant. But we'll see questions in the real. There are no actual TYUs on this paying, but you will see examples where you have to literally, for example, I don't know, imagine you have a grant exactly like we had there. You receive 15,000 in the bank, and you've used it. Let's just say you've used it against this. If you like, you've used it against this machine, for example, 100, and you've used it against the 85, like we said, and you fail. So literally, what you now must do is you must now put through expense of 15 and a liability owing to the people who provided you the grant, and then pay them their money back, 15,000, and bank 15. So we're just basically creating a provision for whatever it is, whatever the balance is, if we've not used all of it. So for example, if we had chosen to only use 7,500, we would only need to put a provision of 7,500. Are you with me? Cool. Great stuff. Yeah, I'll see you in the next video.